Hey guys, welcome back to this week's Mortgage Matters in Minutes, sponsored obviously by Mortgage Specialists, and your host here today, Brent Rasmussen. Thanks to Jonathan last week for filling in and giving you guys some education on how to calculate income, and lenders look at that, as I was actually out instructing real estate continuing education courses. So I am back this week, and this week we're going to talk about how the economy impacts your interest rate. And I know this has been chatted about many times through the years, and lately more than ever, I think we've heard the word inflation. And some that follow a lot of market knowledge and news know that the arch enemy of interest rates is inflation. And we learned that from back in the late 70s, early 80s, as we've seen inflation kick up interest rates to some of the highest that we've ever seen in the mortgage world. And ever since the early 80s, we've seen mortgage interest rates lower, and till this year, seeing the lowest interest rates of all times. Are they going to stay at the lowest rates that we've ever seen forever? We know that that's not possible, and that's not going to occur and not going to happen. But how does the overall economy affect your interest rate? That's the big question. Three different factors. We spoke about inflation, and as we see the cost of goods or cost of items that we spend money on go up, that is what inflation is. And as that price continues to rise, it makes the cost of goods more expensive, which deteriorates, and rates have to rise to keep up with that cost of goods. What many people don't realize, number two, how your rate is affected, is the bond markets. And there are a trading of mortgage-backed securities called MBSs that happen on a daily basis, just like any stock investment. And there's investors that put money into this more safe investment, and they also look at treasuries, T-bills, other safe long-term monies with not a very high return. So the bond market lately has been impacted by the Federal Reserve, which is our last point here on how the economies are affected by interest rates. And the Federal Reserve has been an enormous impact lately here on interest rates. And the reason why that is the case is because the government has been dumping in billions and billions of dollars into mortgage-backed securities. So while interest rates should be higher, the government is intentionally putting money into the mortgage-backed security investment to keep interest rates low. So why would the government want to do that? In theory, they want to keep spending high and continue the market moving and people using their money to invest into building buildings, into the market, so corporations can actually grow and do different things. So a lot of times people would call us and ask, what's going on with the rates this week with the Fed meeting? And actually this week they are meeting, and we'll see what shakes out as when they come out with their summary. There's always keywords in there that people like to analyze, and sometimes the Feds slip up and give some really strong keywords that the markets like. And many times they jump in and they don't really say much of anything, and the voting kind of comes by what has transpired with the Fed when there's different members that give their dovish opinions or their bullish opinions of where rates should be at or where the government should be putting money in the future. So what I really want to kind of portray in this video for you guys this week is that we follow that trading on a regular basis throughout the day. A lot of people think that we have time, which we do, to look at interest rates. We might not be on it every second of the day, but we are on the markets and how the rates are going to be impacted today, this afternoon, tomorrow morning, and possibly a week from now before the curve actually changes. So what we can tell you currently is rates are probably on their way up. As inflation is kicking up, everybody is talking about this and speaking this for a long time. So it's better to lock in your interest rate now sooner than later. But at some point in time, we're going to see that rate increase, and we're going to see daily fluctuations. And maybe the market here in the future isn't as strong, and the Dow Jones stock market might go down lower than it's been lately, which also could impact interest rates. So what we like to explain to you is that mortgage rates are tied by the overall economy, not just the nationwide United States economy, but international policies and things that occur, just as we saw last year with the pandemic, as these really big, scary, impactful things that affect us. The interest rates do drop and lower with the negative financial markets and activities. So hopefully today you learned a little bit. We're not going to go into every intricate detail of how trading works, but I do want to mention here at Mortgage Specialists, we do pay for massive and major economists that keep us posted throughout a daily basis of where interest rates are heading, what's occurring with interest rates right now with the Fed during meetings, and in the future of what the forecast looks like moving forward, so that we can protect you when you're out looking for a home to get the best interest rate for the future. So feel free to contact us anytime at Mortgage Specialists with either a phone call at 402-991-5153, or you can reach out on our website at mtg-specialists.com. And we look forward to talking to you and seeing you all next week. Have a great day. Mortgage Specialists. Driven, trusted, reliable.